Time now for our weekly market monitor who likes tech stocks, but he recommends being selective in the sector. Joining us is Steve Dudash, president of IHT Wealth Management. Steve, welcome. Nice to have you here.
Thank you.
Tech has been extremely volatile as we work through all of these trade headlines. So you did give us 3 picks that you think may be able to weather that storm a little bit better than others. Amazon is your first pick, and there are a lot of very bullish calls on the street about Amazon, but tell me why you like it.
Listen, our economy right now is in a very, very good place. The only thing that's holding it back is the threat of this trade war. And this trade war, it's just show. This is theatrics. This is just about people, two sides, acting strong and trying to negotiate the best terms they can, which is normal. Like you had Mike on earlier this segment talking about how the markets have pulled back 10%, but that's a normal year. That's where we're at right now. So we're looking at defensive technology companies, and that means companies that have lots of cash, lots of earnings, and frankly something that me and you are going to use more and more of no matter what's going on. But with Amazon in particular, you can make the argument that if the economy pulls back and if this trade war drags on, it actually helps a company like Amazon because frankly the barrier to entry to get into their business is so massively high that if the markets pull back, the economy pulls back, it's going to squash anyone else who's trying to get in there and therefore make the market even tighter or better for their type of company.
All right, next on the list is VMware.
Yeah, VMware, this is a little bit different, but again, this is a defensive term I'm thinking about for people's portfolios. We're talking about a company that takes data and crams it down and puts it in smaller spaces and makes it more economical to store, more economical to transfer. If things get tighter, if the trade war does go on for a little bit longer, companies are going to need to make more profitable ways of holding data. Me and you both use data more today than we did 5 years ago, and 5 years from now we're going to use it twice as much, if not more than that. Companies like this will be profitable now. They are profitable now, but in the future, as the economy keeps growing, as we keep using technology, the Internet of Things more and more, you're only going to see more growth in these type of firms.
Google's parent Alphabet is also on the list. There are some regulatory concerns that have been weighing on the stock a little bit, but why do you like Alphabet?
Those regulatory concerns and the market pulling back is why something like this right now is a buy, and the whole segment is a buy right now, in the sense that Google is going to be used more and more in the future. If this economy pulls back, we are not going to use Google less. If unemployment goes up a couple of points, we're not going to use Google less. You're right. There are some regulatory things both here and overseas. That's never going to go away. When you're talking about massive companies, you're always going to have that aspect. But you're buying in at a cheap price right now. That's really what we're talking about with any of these opportunities. You're getting in at nice price points because people are afraid of things that shouldn't be afraid of right now, and therefore makes things more valuable for us.
Steve, thank you very much. Steve Dudash with IHT Wealth Management.